Welcome back, everybody. Welcome back to Perpetual Pip. This is your host, Will Gomez, Chief Currency Strategist for Perpetual Pip, and it's time for another Trading 101 discussion. Today, what we're going to be talking about is how to incorporate counter trend lines into our trading. Now, when it comes to our trading so far, we've been able to discuss what candlestick formations are, how to interpret them, how to trade them, and even how to use the Fibonacci retracement tool in our trading. So we generally understand the hows on how to go about actually placing these trades. Shoot, we've even gone as far enough as talking about what kind of entry orders to be able to use when. So if you've had the opportunity to be able to trade, what we need to understand for any given amount of time, what we need to start to get more familiar with is when the right time to be able to place a trade is. Right? We understand the hows, we need to understand the whens a little better. So if you've had the chance to do any kind of trading so far, the chances are really, really high that you've come across a situation where you decided to enter into the position, and then shortly after that, it almost seems like the market was waiting for you to get in to turn around and go in the opposite direction, right? Or maybe just to dip down low enough to stop you out. It seems like right after we get in, we immediately encounter the market deciding to go in the opposite direction. And the most likely explanation for this is because we've decided to get in at the end of a swing, or even worse, the end of a de-extension. So our knowledge of the candlestick formation, right, interpreting that the market is giving us a signal in the direction of the trend is good, but it may not. Just like if we're not paying attention to the Fibonacci's, it may not really give us the whole picture. And if we're not paying attention to the whole picture, we end up in a situation where we get involved only to have the market go in the opposite direction. So try and remember that the bulls and the bears need their periods of rest, right? They will score a target, they'll reach a target price point, and then target price points being either a level of resistance or support. Usually the bulls are targeting levels of resistance, the bears are targeting levels of support. And then once they exert themselves to being able to reach that area, most likely they're going to try and pull back. They're going to need a little breather. And as they kind of take a breath, the opposite team will immediately pounce, trying to take control back from them. So how do we determine what the opportune moment is? Well, let's review what we already know. We know that a trend line shows us the overall trend direction of the market, who's in control overall. So if the market is making higher highs and higher lows, we know that overall the bulls are in control. We know that if the market is making lower lows and lower highs, then we know that the bears are in control overall. But since we can see who is overall in control, then we can also see when they are not pushing the market in the overall direction of the trend, right? We can't say that the market is just moving in a straight line here in the bullish direction. We see that there are periods where it is moving in that direction and periods where it's either sideways or downright pulling against that overall trend direction. So these points where the market is not moving in the direction of the trend, these are known as retracements. And entering in during these retracements is usually what ends up costing traders. So let's talk about what counter trend lines are. The word counter implies against. Right? Counter means against. So a counter trend line, therefore, allows us to measure movement against the current trend direction, or retracement action. Now, why is the counter trend line so important? Again, if we kind of work logically through what we already know, we know that the market can only go up or down. And so we use trend lines to identify that overall direction, who's overall in control, right? We know then that when that trend line breaks, we are looking at a potential change in direction. That's how we identified the reversal pattern, right? Remember we talked about the crown reversal pattern and the head and shoulders. The very first thing that lets us know that the trend is getting ready to change direction is a break of a trend line. And since we know that that overall trend line indicates who is in control, then when the market violates that line, we're expecting it to start going in the opposite direction. So if we kind of make that a little bit micro and shift gears to think about, well, what if I started to monitor when the market is not moving in the direction of the trend? Then what we realize is, since a break of a trend line is indicative of a change in direction, if we start to measure not only with our overall trend line is letting us know who generally is in control. If we draw a smaller trend line against the trend direction to monitor when the market is not moving in the direction of the trend, then it stands to reason that when the market breaks that, if it's no longer moving against the trend, then it must be getting ready to move with the trend. That is why the counter trend line is so important, because effectively it provides us with an entry signal. It determines the when. I went ahead and typed up, I've had this before, I believe I shared this with you guys back when we discussed the overall trend direction, how to determine trend direction video. If you haven't had the chance to watch that, I strongly suggest it. But in any case, if you haven't had the chance to download this document, look out for the link in the description of this video. If you're watching this on YouTube, the link for this document will be in the description section. You can go right to it and download this, or you can take notes on your own, completely okay. This document does include notes on how to be able to plot a trend line and monitor a normal trend line, and it also incorporates the counter trend line information as well. All right, so be on the lookout for that. I will make that available for you. Here is a chart. Okay, now let's try and explore this trend line on a chart. We've got our normal trend lines as we understand them, right? We start at the lowest low, we go across all of the lows before our highest high. This is how we draw our trend lines appropriately. Please make sure that you watch that trend direction video to get more of a description on that, or be sure to join us during the live sessions that I host on perpetualpip.com to get more live interaction, actual trading experience in there. The trend line generally indicates who is in control here. So since the market is making higher highs and higher lows, we've drawn an uptrend line and an inner uptrend line. Now, when we have these sections, you can see the sections here where the market is not pushing in the direction of the trend, right? This is the market pulling against the trend right over here. Okay, the market pulling against the trend right over here. The market pulling against the trend in several locations here, 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 right? So we can clearly see that the market is not always moving in the direction of the trend. So what do? We're going to incorporate counter trend lines. Now these are the rules to being able to draw a counter trend line. Remember once again that the function of the counter trend line is to measure retracement action or movement against the trend. So you're going to need then, in order to draw an appropriate counter trend line, you're going to need at least 3 retracement candles. This is going to be subject to the trend. If you're in an uptrend, then that means that you're in a bullish trend. Anything that is not a bullish candle, bearish candles, are going to be considered retracement candles in this situation. If you're in a downtrend, however, then overall the market is in control of the bears, making lower lows and lower highs. So anything that is not a bearish candle in a downtrend would be a retracement candle. Anything that is not a bearish candle, bullish candles, would be considered a retracement candle in a downtrend. What you're going to do is you're going to look to draw across the bodies of these retracement candles, right? Only a decision candle is going to be allowed to break the counter trend line. An indecision candle cannot be allowed to break the counter trend line. Why? Well, in our candlestick video, we talked about an indecision candle, or a candle that is mostly wick, being a non-actionable candlestick formation. The name itself says it all. It's indecision. So since the market doesn't know what it wants to do at that point in time, it cannot be allowed to break the counter trend line. You would simply absorb it into the retracement. When you see a decision candlestick formation that breaks the counter trend line, you've got yourself an entry point. So let's explore a few scenarios here. We've got the market making a clearly bullish move here to the north. What we're looking for afterwards is for the market to show some semblance of moving against the trend. There's no specific angle to search for a counter trend line. You do want it to be as aggressive as possible, but there's no specific angle that you need to obey. So let's kind of explore this a little bit. Here's a counter trend line. The market has, I've got one, two, and 3 retracement candles. As soon as I got 3 retracement candles, I started at the wick and went across the bodies of all the retracement candles, right? So initially, this looked like this, right? And I can't really draw straight lines with this pen tool. But once I have the line going across, the only thing that I'm going to allow to break that counter trend line is going to be a decision candle. As you can see, when this bullish decision candle finally broke that line, we have subsequent movement to the north in the direction of the trend. That's what we're looking for. So again, you will see time after time after time that when these counter trend lines are broken by decision candles in the direction of the trend, you will see subsequent movement in the direction of the trend. This is another example right here. There's another example right there. There's another example right there, and so on and so on. When you see these candles, decision candles, that the majority of the candle breaks to the right side of the counter trend line, you're going to see some subsequent market movement, some of them more than others. Right? This is how we draw a counter trend line. And effectively, when you see the break of a counter trend line, especially when it's in the direction of the trend, you're looking at entry opportunities. Entry opportunities. If the market is no longer moving against the trend, then it must be getting ready to move for the trend. Now, you can see that this is not a guarantee. There are going to be times where this will fail. The market ends up going sideways instead, or does a very light move in the direction of the trend. How can we refine this even further to ensure that we've got nice, juicy moves in the direction of the trend and that we're getting in with the highest percentage chance of success? We're going to talk about that next time in our next discussion. We're going to talk about the stochastic RSI. This is an indicator that tracks wave movements of the market, and if we use this in conjunction with counter trendline breaks, we're going to be able to increase our win percentage. We'll talk more about that in the next video. If you enjoyed this video, you're enjoying what you're learning, please don't hesitate to like and subscribe to our channel. All the content is, of course, available for free at my site, perpetualpip.com. You can go in and watch the tutorials, just create an account. Everything is completely free. If you should decide later on that you want to put some rubber to the road or kind of bridge the theory that you're learning here to actual live market application, feel free to join us in the live discussions after you create your account. This has been Will Gomez for Perpetual Pip. If you have any questions, comments, or concerns, please don't hesitate. Email me directly, will@perpetualpip.com or perpetualpip@gmail.com. Thanks again. See you next time.